You did everything the right way. You saved up, you found a program that let you put 3.5% down, and in 2022, you bought your first home in Cape Coral, Florida. The payment was tight but manageable. You figured you were building equity. You figured prices would keep rising or at worst, hold steady. Then something happened that nobody in the real estate industry told you was possible. 3 years later, your home is worth $43,000 less than what you paid for it. Your loan balance is still $39,000 higher than the current market value of the house. You cannot sell without bringing cash you do not have to the closing table. You cannot refinance because no lender will touch a loan at 111% loan to value. And every month you stay in that home costs you more than $3,300 once you add in property taxes and Florida homeowners insurance. You are not alone. According to Totality, formerly known as CoreLogic, 1.1 million Americans are in exactly that position right now. That is the highest count since 2018. And according to the Mortgage Bankers Association, FHA serious delinquency just surged 212 basis points in a single year. The conventional rate dropped 1 basis point. The VA rate ticked up 10. FHA exploded. And that number tells you everything about who is actually carrying the damage in this market. My name is David Cole. I am the Editor-in-Chief of Housing Intel. Before we get into this, I want to ask you something directly. This channel is funded by viewers who believe that independent, data-first real estate analysis matters. If you have gotten value from what we do here, consider becoming a member of Housing Intel today. Members get early access to every report, the full data source list behind each video, and direct input on which markets we cover next. You will find the Join button right below this video. We are building something that the real estate industry does not want to exist. If you believe in that mission, membership is how you support it. Now let us get into what the numbers actually show. We are in Phase 3. Phase 1 was the freeze when transaction volume collapsed and buyers stepped back. Phase 2 was forced selling beginning in pockets when the first wave of over-leveraged buyers started hitting the market. Phase 3 is when the forced selling stops being individual stories and starts feeding itself. That is the phase we just entered. Let me walk you through exactly where the damage is concentrated because mainstream coverage keeps averaging this away. The Mortgage Bankers Association First Quarter 2026 National Delinquency Survey came out on May 14th. FHA serious delinquency rose 212 basis points year over year. The conventional rate dropped 1 basis point. The VA rate ticked up 10. FHA exploded. Intercontinental Exchange mortgage technology data shows FHA borrowers drove more than 80% of the rise in seriously delinquent loans over the past year. FHA foreclosure inventory just hit its highest level since the fourth quarter of 2018. And here is the historical benchmark you need to internalize. Strip out the pandemic spike. The FHA serious delinquency rate is now at levels we have not seen since 2011 and 2012. That was the bottom of the last housing crash. We are not approaching that level of stress at the entry level of the market. We are sitting in it. Atom Data Solutions released April foreclosure numbers. Filings are up 18% year over year. Starts are up 12%. And bank repossessions, meaning actual completed foreclosures where the bank took the keys, are up 42%. The foreclosure machine that idled for 5 years just turned back on. And it turned back on at the entry level first. So which cities are getting hit first? The Intercontinental Exchange Mortgage Technology. February 2026. Mortgage Monitor identifies 8 metros where more than 1 in 20 mortgages is now underwater. The top 5, the epicenter of Phase 3, are Lakeland, Florida at 10.8% of mortgages underwater. Cape Coral, Florida at 10.1%. Austin, Texas at 9.2%. San Antonio, Texas at 8.8%. And Jacksonville, Florida at 6.3%. Now let me show you exactly what that means for a real buyer, because the percentage does not hit until you see the math. Here is the math on a 2022 Cape Coral Peak buyer using an FHA loan, which is what most first-time buyers in Florida used during that period. Purchase price $450,000, 3.5% down. Loan balance starts around $398,000 once you add the upfront mortgage insurance premium. Standard 5.75% FHA rate for that vintage. 3.5 years later, here is where they stand. Cape Coral home prices are down 15.3% from peak per Intercontinental Exchange mortgage technology. The home is now worth roughly $343,000. FHA amortizes slowly, so the balance is still around $382,000. That is $39,000 underwater. Loan to value, 111%. They cannot sell unless they bring cash to the closing table. The monthly payment runs $3,300 to $3,400 when you include principal, interest, the FHA mortgage insurance premium, Cape Coral property taxes, and Florida homeowners insurance, averaging around $3,600 per year according to the Florida Office of Insurance Regulation. And that is before flood insurance. According to Intercontinental Exchange mortgage technology, roughly 70% of 2023 and 2024 vintage FHA loans in Cape Coral are underwater right now. In Austin, 65% of 2022 vintage FHA loans are underwater. This is not a story about one family. It is a vintage-level problem. 2 out of every 3 first-time buyers who closed in these markets at the peak are trapped. Now let me show you something that no one else is reporting on. When you break down the negative equity by lender, the picture is not random. According to Ginnie Mae mortgage-backed securities data, here are the ratios. At Lennar Mortgage, the captive lender owned by America's largest home builder, roughly 27% of their FHA loans are underwater right now. At DHI Mortgage, the captive lender owned by D.R. Horton, roughly 18% of their FHA loans are underwater. At Rocket Mortgage, a non-builder lender selling into the same general market, roughly 10%. The builder-affiliated lenders have nearly 3 times the underwater rate of an independent lender working the same population. That is not random. That is a system. Here is how it worked. During 2022, 2023, and 2024, public home builders kept their sales volume alive by offering aggressive rate buydowns, closing cost credits, and incentives funded through their captive mortgage subsidiaries. They held headline prices firm and absorbed the cost in the financing. That kept reported home prices propped up. It also locked buyers into the peak price of the home even after the underlying market started falling. Lennar reported first quarter 2026 net earnings of $229 million versus $520 million a year earlier. Gross margin compressed from 18.7% to 15.2%, with incentives now running around 14% of sale price. D.R. Horton's first quarter showed earnings declining year over year on what they themselves called intensive sales incentives. Their own words in their own earnings report, this is the largest engineered financial trap placed on first-time American buyers since the subprime crisis. America's largest public home builders sold homes at peak prices using buy-down financing through their captive lenders. Those lenders pulled in lower credit, thin down payment, FHA borrowers. And now nearly 1 in 4 Lennar Mortgage FHA buyers is trapped underwater on a home they cannot sell, cannot refinance, and cannot walk away from without destroying their credit. The negative equity did not happen to those buyers. It was sold to them, and the same companies are still doing it right now, this quarter. Before we get to the final part of this analysis, if this video is giving you data that you have not seen anywhere else, please hit the Super Thanks button below. That direct support is what makes it possible for us to keep doing this work independent of any real estate industry funding. Every contribution, large or small, goes directly into the next report. Thank you. Now back to the data. The Federal Reserve has cut rates 6 times since September of 2024. The federal funds rate is now 3.5 to 3.75%. And the 30-year fixed mortgage rate sits at 6.53%, according to Freddie Mac, as of late May 2026. Mortgage rates have barely moved. The reason is that mortgage rates track the 10-year Treasury, not the federal funds rate. We saw that play out in real time. In 2024, mortgage rates fell before the Fed's September cut. After the cut, they went up. Now here is the trap that the Cape Coral FHA buyer I just walked you through cannot escape. The AEI Housing Center projects that under current rate paths and continued tight supply, home price appreciation could run roughly 10% per year nationally if rates settle in the mid-4% range. That sounds like good news for homeowners until you realize where the appreciation actually happens. The S&P CoreLogic Case-Shiller Index for March 2026 shows Chicago up 6.1% year over year, New York up 4%, Cleveland up 3%. FHFA data has Austin at negative 6.9%, the worst metro in the country. Every single one of the 30 metros currently in year-over-year decline is in the South or West. So here is what a Fed rate cut actually does. It pushes mortgage demand back into the markets that did not break: Chicago, New York, Cleveland, the Northeast, and Midwest. It does almost nothing for the distressed FHA buyer in Cape Coral or Austin, because those markets have a supply problem, not a demand problem. The Fed cut reinflates equity in the safe markets, while the trapped buyers in the distressed metros stay trapped, watching everyone else get richer while they cannot move. This is Phase 3 completing itself. The same buyers who got sold the peak price at the entry level are now going to watch a recovery they cannot participate in. Here is what the data tells you to do now, depending on where you stand. If you own a home in Lakeland, Cape Coral, Austin, San Antonio, Jacksonville, Tampa, Phoenix, or any other metro currently in year-over-year decline, and you actually need to sell in the next 18 months, you price aggressively now. Sellers in Austin who waited have lost 27.8% since the 2022 peak. Every month you hold is a lower number. If you are a buyer right now and someone is trying to sell you a new construction home with a builder rate buydown through their captive lender, you negotiate the purchase price down by the amount of the incentive and finance through an independent lender. Or you walk. Do not let yourself become the next 27%. That is the lesson of this entire video. If you own a home in a market that is still appreciating, Chicago, New York, Cleveland, anywhere in the Northeast and Midwest, do not get comfortable. Your equity is real today, but the same forces that built Phase 3 in the Sun Belt, price, vintage, and lender behavior, are forces that eventually find every market when affordability breaks. And if you are sitting on cash watching this and waiting for opportunity, start monitoring the distressed metros for inventory listed by Lennar Mortgage and DHI Mortgage borrowers who are forced into short sales. That is where the real discounts are coming over the next 12 to 24 months. It is already starting. Phase 3 is the engineered collapse. Remember that framing, because Phase 4, when this stops being concentrated in the FHA vintage cohort and starts spreading into conventional loans, strategic defaults, and regional bank balance sheets, is already loading. Subscribe to Housing Intel and hit the notification bell so the next report lands in your feed the moment it drops. This channel publishes every Monday, Wednesday, and Friday. Every report is built on verified data, not speculation, not real estate industry talking points. We are here to give you the full picture before it hits the mainstream news. Subscribe now, and share this video with anyone who bought a home in these markets in 2022 or or 2023. They need to see this data. We will see you in the next one.